Hold on to your hat because I think you're going to see what I believe is going to be a stunning rally here, and then later this year, an equally stunning decline. So I think we're going to make some history this year.
Physical silver and gold in your hands, personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com. Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And back with us today is David Hunter. He has 40 plus years experience on Wall Street. He is the chief macro strategist at Contrarian Macro Advisors, and he is the author of the Contrarian Value Advisor Letter. David, thank you so much for joining us today.
Oh, thanks for having me, Elijah. Happy Good Friday.
Definitely. Happy Good Friday to you as well. And the first topic I'd like to discuss with you today is kind of to get an update on where we are in this stock market, secular bull market that you've been talking about for so long. Last time we had you on, you made a pretty bold prediction that this year we were going to see an 80% stock market decline. And that's based on looking back almost 40 years where we've been in the stock market and everything. And you're saying right now we're in the kind of the last melt up phase. Can you expand on where we are right now with respect to the stock market?
Sure. I have for quite some time been talking about a melt up into what I call a secular bull market top that started back in 1982. I think we're likely to see that top in this quarter. We just, the S&P just made it over 4,000 as of yesterday. And I think we're probably going to see something. I've been saying 4,600 on the S&P, but I've in my latest letter, I'm revising that up to 4,700. Dow probably up around 38,000 and NASDAQ around 17,000. So somewhere between, depending on the index, between a 15 and 25 or 30% rise from here in this quarter. That's what I think. And that's what a melt up is you cover an awful lot of ground in a short period of time. So I think we've begun that last, what I call a parabolic melt up, meaning it will go pretty vertical, cover a lot of territory in a short time. And I think the reasons for that are pretty straightforward. We're seeing the vaccination program rolling out successfully. More and more people are being vaccinated. You're seeing the economy reopen, and that means people are returning to restaurants. They are making plans for vacations this summer. Airline traffic is picking up. Lodging is picking up. And even, businesses are having some of their workers at least return to the office. So you are seeing the beginnings of what I think is a reopening, and I think that's going to pick up speed here in second quarter into the third quarter. And we're seeing GDP numbers of 7 and 8% and upwards from there. Those are all very bullish things that I think are going to get investors excited. I think earnings are accelerating, so that's obviously a big thing for the stock market. And I think that all goes together to and with a positive stock market tape to kind of get you into a mode of fear of missing out, jumping on the bandwagon because everything's looking better. And it's funny because, last March, a year ago, people thought I was crazy when I was talking about a melt up and, numbers like 4,500 on the S&P. And that was obviously because you were seeing the Fed pour money into the system, the government provide a lot of stimulus. You're going to have the reverse happen here soon, which is that the economy's picking up speed and is going to be demanding money. That money means liquidity comes out of the capital markets, both bonds and stocks, to fulfill needs in the business sector or in the economy. Whereas a year ago, there was nowhere for that money to go but in the capital markets. So that's hard for investors to understand because they look last year and they go, why is the market going up when the economy is going down? Now it's going to be the opposite at some point is why is the economy going up and the market's, going the other way? So it's it's part of the liquidity cycle. It's part of how money flows from real economy to capital markets and back. But I do think we very likely see a top this quarter. If we don't see it this quarter, we certainly see it next quarter. So, it's hard to pinpoint something that's been happening for 39 years. I'll be happy if I come within several months of it, but I think we're getting pretty close.
And that's a really interesting point, because I think the way that you're looking at this is a very long-term perspective, which is really great, because so many people nowadays just talk about the daily price actions, and that's not what you're looking at. You're looking at a secular bull market, and we're at the tail end of that, and it's been going on for 39 years. Can you expand on what does it mean for there to be a secular bull market that lasts that long?
Sure. And there are a lot of different takes on when a bull market started, was cyclical or secular, and where we are in that. But I date it back to 1982 simply because that's when inflation peaked and the whole disinflation process started. So we began with interest rates at 15% back in 1982 and moved them down to close to zero in this past year on the 10-year. That's it, and that tracked with inflation that started up around 20% back in the early 80s and has come down to less than 1%. So what you have is in the stock market, PE multiples go inverse to inflation and interest rates. So as interest rates come down, PE multiples, price earnings multiples go up. And that's why you had a bull market. I believe, other people date secular bull markets from 2000, et cetera. But I use 1982 simply because that was the beginnings of a huge disinflation cycle that has driven stocks for all this time. And by the way, the Dow back in 1982 was 780 points, or 780. Today it's over 33,000. So that's what a secular bull market looks like, is it's many cyclical bull markets within one big long cycle. And so we've had cyclical bull markets, 1982 to 1991 or two, and then another one that peaked out in the early 2000s, and then another one that peaked out in 2008, 2007, 8. And now this one, the cyclical bull and the secular bull will peak at the same time. And then I think we go into what is going to be a very historic bear market that could take us down peak to trough as much as 80%.
And where do you get that number of 80% for a stock decline?
Sure. There's no real science behind it, but it's our biggest decline, I guess, goes back to 1929. That one peak to trough was about 90%. I don't think we've had anything beyond the 66% peak to trough that we saw in 2008-9. I simply see an economic, and we'll talk about this later, but what I'm calling an economic bust, something we haven't seen in the post-World War II era, something bigger than any downturn we've had in the post-World War II era. That's what I think we're heading for here. If we're going to have the biggest downturn in the last, 80 years, it stands to reason we're going to have the biggest bear market in 80 years. And part of that, I think, is because we are up on stilts. The market that's been an amazing run, but it really is extreme. So there's more to give up, and it's also very leveraged, both with debt in the economy and derivatives. And derivatives, I think, are going to both speed up the decline and exacerbate it, meaning make it bigger.
And one of the things that we've seen really since 2008 is kind of a hesitancy on the Fed's part to, reduce the amount of quantitative easing they're doing and stuff like that, because, it has such a big impact on the markets, the whole thing about a taper tantrum and all of that. So how is the Fed going to allow this to happen?
Yeah, they will not do it purposely. They will not allow it to happen because they think it should. What I think is going to happen is they're going to get caught between a rock and a hard place meaning that you're seeing inflation break out here. And at some point this year, I think, even though Jay Powell says it's 2 years off, I think at some point this year they're going to be forced to tighten because the economy is overheating and inflation's starting to speed up beyond levels that they're even comfortable with. So yeah, we're pushing up towards 2% now. And again, these are the official inflation deflator indexes. It's not. I know there are a lot of people out there say inflation's a lot higher than what the government puts out, and I agree with that. But to compare apples to apples, they use these the deflator index, and it's pushing up against 2%. They pretty much have said we'll let it run hot to probably 3%. I wouldn't be surprised if it pushes beyond 3% this year. And it's at that point where I don't think they're going to be able to say, oh, it's not a problem, it's transitory. I think at that point they're going to start thinking, gee, we've printed trillions of dollars more than we've ever printed before, and we know money can become inflationary. It looks like this isn't transitory, and we've got to act. So I feel you're going to see tightening sometime later this year, not this quarter, and even if it doesn't mean they're going to raise interest rates, because I don't think they're going to hike Fed funds rates, the market's going to push up the rates so that you're going to see the 10-year. I have a forecast of 2.5% on the 10-year, probably 3% on the 30-year. Those are numbers that I think are going to make the markets very uncomfortable and ultimately negative.
And you mentioned the bond market, right? And you actually just tweeted about this, that you think there's actually a bond market rally starting right now and that we're going to see rates lower. Can you expand on that?
Yeah, absolutely. Yeah, it gets a little confusing because, as I say, markets don't move in straight lines and my forecasts don't move in straight lines. So people will hear the talk about Fed tightening and then they go, but you're talking about a 1.2% 10-year. Well, that doesn't jive. Well, we've had this run. I was, 6 months ago, one of the few that was calling for higher rates and saying that we're going to see a rate back up to at least 1.2, maybe 1.5%. And we got to 1.5 and shot right through that to 1.75. So, you've moved from 0.6 to 1.75 in 6 months' time. You're very oversold on in the bond market, overbought in interest rates. And so it's, technically and sentiment-wise, it looks like we're set up for a rally here in bonds. That'll take us back to, say, 120. Still doesn't get us anywhere near back to 0.6, but it's a step back in a stair-step process. And then from that 120, give or take a few basis points, I expect the run up to 250 probably in the second half of this year.
And how will that impact the gold and silver markets? Because I know you've also been predicting that kind of the next price points for precious metals are gold, $2,500, silver, $45 to $50. We've seen the treasury yields, this rally impacting gold and silver negatively. So if we see it come down, then it seems like that's bullish. But if we see rates going way back up, it seems like that would be bearish again. So how did the rates then relate to what you see happening for precious metals?
Yeah, it's part of why I've been bullish, as you know, on gold and silver, and they haven't done things as quickly as I would have expected. We had a great run last March to August, early August, and then they have been consolidating ever since. And I thought we were going to see the rally begin late last year. It didn't have. It started and then it stopped. The first few months of this year it started, then it stopped. And part of that, I think, is because I think there's a misread on interest rates. And again, I hesitate to say misread because the market's always right, but I think algos are playing a big role here, and they like simple rules. And their simple rule, I think, right now for gold and silver, and keep in mind their rules change, so it's not something that's permanent. But right now, their simple rule for gold and silver, and particularly gold, is that rates up, gold down. And they claim to say real rates up, gold down. But I take issue with real rates up because, as I said, the indexes for inflation may be telling us that it's still under 2%. But inflation truly, when you look at commodity prices and you look at other things where prices are rising, inflation's truly risen a lot in the last few months. And so if you were using unofficial numbers, real rates would be going down, even though nominal rates have been going up. So maybe algos can't figure that out or don't want to figure that out or whatever. So whatever the reason, they felt rates up, gold down in the last few months. Well, first of all, we're going to have a nominal rate rally here. So we're going to go from 175 to 120. That will help gold and silver here. And then I think when we start the tightening cycle, when we start the rates moving back up, and that may only be a month or 6 or 8 weeks from now, but whenever it is, I don't think it's going to stop the rally in gold and silver, because I think real rates will, by then, it'll be obvious that real rates are going down even by the popular inflation indexes. So, if let's say inflation goes to 4%, which I think is real possible here, and rates go from 120 to 2.5. You do that in your head, and you can pretty much tell real rates are still coming down if that's all that you're going to see in the rise in rates. So I am, and I've said this a lot on Twitter, I'm not big on one factor analysis. There are lots of things that can go into a gold rally or a silver rally. Silver certainly is more economically sensitive, and there's plenty of demand coming from all the alternative batteries and alternative energy, et cetera, solar panels. Plus, in gold's case, you've got monetary issues that I think, inflation's picking up. The dollar, I think, is going to decline again. So I think there's lots of reasons other than interest rates that could drive it. So I just don't like one factor analysis.
And you've also mentioned that, you're not talking about, in any of these circumstances, prices just going in a straight line, right? How your forecast also for gold more long term is 10,000 and silver 300. And it's not going to be, a straight line there. There's going to be a lot of bumps along the road. You've kind of used the analogy also of the Grand Canyon from rim to rim. There's this big canyon in between it, right? So
precisely. Yeah.
Exactly. So can you expand on that, like what you see for precious metals going forward in the rocky road ahead?
Sure. I think the 2,500 on gold, the 45 to 50 that I'm using for a target for silver, probably is a third quarter number. I get beat up on Twitter for putting dates out there and then keep moving my dates, but the markets dictate. As I say, my timing is a really just best guess at the time. It's not meant to be part of the true forecast. But anyway, from there, in a bust, I think pretty much all assets are going to get hit, with the exception of treasuries and the dollar. So gold and silver won't be excluded. I don't think they go down nearly as much as the stock market. So, they pull back maybe 30%, what have you, maybe a little more than that. And so people who are buying gold here can make their choice as to whether they want to ride through what happens in the bust, because it could be more. I might be wrong, and it might actually slide 50% for all I know. But what I do feel pretty comfortable saying is that in a bust, it's going to get hit. Everything's going to get hit. So people should not be lulled to sleep in terms of, if gold gets up to 2,500 this year and silver to 45 or 50, or maybe higher, they shouldn't be lulled to sleep into thinking, okay, we're off to the races and we're going to see 10,000 on gold and we're going to see, 300 plus on silver. Yes, you are, but you're going to have a discomfort, for probably several months while it corrects pretty strongly. And I guess I'd point to the distress that I've seen on Twitter from gold moving from 2,100 back down to 1,700, or silver moving from 30 back down to the low 20s, and has been in the mid 20s for most of the time. And yet you would think from all the comments on Twitter that people are just devastated by the decline. So if that's going to hurt them, a bust, I think, is going to be hard. So, people have to know what their comfort zone is. I'm not advising whether you hold it through the bust or not. I just want them to be aware that it's not a straight line from here to 10,000. And as I say, 10,000 plus. So I don't know whether that means 12,000, 15,000. I think gold's going to be a huge, huge player, huge winner in the recovery cycle that follows the bust. But it's just not a straight line.
I think that's a good point you make. Obviously, we can't give financial advice, but to really, people should understand what they're comfortable with, what kind of a roller coaster they're comfortable with. Kind of on that topic, like, you're forecasting a very crazy and intense road ahead for the next couple of years. So how does someone navigate that? Can you expand on that when it comes to investing?
Sure. First of all, I think people, when they see, and I had it this morning, in fact, from a professional investor, when they see a forecast like mine, they right away assume this guy must just be caught up in the craziness. He's one of those guys that gets really extremely bullish at the top and extremely bearish at the bottom. As you know, I'm a contrarian. I'm quite the opposite, typically. It's where we are in the cycle. It's not my personality. It's not that I'm just, enjoying kind of these big swings, throwing out big numbers and big swings. So when I talk about an 80% decline or a melt up to 17,000 on the NASDAQ or 10,000 gold, it's because we're nearing the end of a super cycle. And this is a new term. We just talked about a secular bull market, but super cycle I define as between two depressions. So the last depression was the Great Depression of the 30s. I think the next depression is probably the 2030s. So we have maybe this decade to go before we come to the end of the super cycle that started back in, say, 1940. So as you get to the end of any cycle, but particularly a super cycle, the volatility gets huge. You get big ups and big downs. So what we're seeing here is, I think, really the result of where we are in the big cycle. So with that being said, people, I always say you need to know what your sleep at night quotient is. If you're really, losing sleep over your portfolio, you really are probably, not in and everybody's going to get nervous when markets go against us. But when it really starts affecting your stress levels and your sleep at night, it's probably a sign that you need to step back and take some of the risk off. I'm not an advisor, so I can't give advice. I'm really just talking in generalities here. But and so if we're coming to what is a 39-year top, if I'm right, and then to be followed by the biggest bear market we've seen in the last 80 plus years, it stands to reason that people need to know they're not going to, even the best of us, even the best professionals, can't call this stuff so precisely that they can, pick the top and pick the bottom. Far from it. In fact, most professionals get it backwards. So retail investors should be aware that, we're entering, even though there's big returns coming here short term, I believe, a lot in the short time. Just know, time wise, we're up at the high end of the risk scale, and that we're about to enter, meaning sometime in the next 6 to 9 months, maybe sooner, we're about to enter a period of very high downside volatility. And so plan accordingly, just know there'll be other opportunities. So don't get caught up. The biggest message I guess I can give is don't get caught up in the tape. Don't get caught up, as I always say, at bottoms, nobody wants to buy. At tops, everybody's bullish. So in the next few months, I think you're going to see euphoria. You're going to see all those people that for the last year fought this market rally and said, it doesn't make sense, it's irrational, the Fed's just pushing it up. All of a sudden, because the economy is opening up and the market's moving up, you're going to have everybody getting more comfortable, when in fact, as a contrarian, they should be getting less comfortable. It's, and that's the other thing. Market isn't illogical. It's just how people think about it. It doesn't add up, It, as I said before, it's a liquidity cycle. At the bottom, in 1982 or the bottom last March, the Fed's turning on the spigot and printing money. The economy is not demanding that money because the economy is bad. That's why the Fed's printing money. So it has to go somewhere. It goes to the capital markets. It goes to the stock market. When the economy starts getting going again, it demands money. People want to start new businesses. People want to borrow money to buy a house. People want to do different things. That money has to come from somewhere. It comes back out of the capital markets, bonds and stocks. So it, people think stock market up, economy up, stock market up. But at some point, it's stock market, economy up, stock market down.
All right. Well, David, we really appreciate your time today. And yeah, if people are interested in learning more, hearing more of these interviews, then they can hit the subscribe button and the bell icon. And if people are interested in learning more about your work, where can they find you?
I'm sure they can find me at Twitter most of the time. I tweet there, if not every day, pretty much, several times a week. And so my Twitter handle is at Dave H. Contrarian. So that's at Dave H. Contrarian. And then I also have a investment letter that is by subscription. There is a cost to it. If people are interested, the easiest way to get a hold of me is just to direct message me on Twitter, and I'll get right back to you with details on the letter if you're interested.
Fantastic. Any last thoughts before we let you go, David?
No, other than hold on to your hat, because I think you're going to see what I believe is going to be a stunning rally here, and then later this year, an equally stunning decline. So I think we're going to make some history this year.
Definitely. And as we ended our last interview, it'll be great to kind of circle back maybe in a few months and see where we are. Last time you were talking about this melt up boom, and it seems like that's what we're seeing right now. So it's definitely very interesting to see how this is all progressing. But once again, David, thank you so much for your time and insights today.
Yeah, thanks for having me, Elijah.
Physical silver and gold in your hands, personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com.